Good day, payroll professionals. My name is Tanya Tosen, and today I'm going to present the aftermath following the 2019 budget speech, which was held on the 20th of February 2019. Firstly, I'd like to inform you where I obtained all my information from. The changes I will be presenting to you today came from the budget speech, as well as the guide for the employers in respect of employees tax for the 2020 tax year. That is a critical guide that most payroll professionals rely heavily on in respect of taxes. So what were the key changes to the tax tables and certain benefits? It is for the first time in living memory, there was no inflationary adjustment to any of the tax tables. And this being an election year speaks of the situation that our country is currently faced with. This means that the most vulnerable are your lower income earners. This impacts them mainly. As a summary, each employee gets 153 Rand more per annum. This equates to 12 Rand 75 cents per month. This tax relief is due to the primary rebate change from 14,067 Rand from last year to 14,220 Rand this year. This also means that the tax threshold has been raised from 78,150 Rand to 79,000 for the 2020 tax year. Let's look at your medical aid tax credits. The 2018 budget review announced that medical tax credits would be increased below the rate of inflation over a 3-year period to help fund the rollout of national health insurance. To generate additional revenue of R1 billion in 2019-2020, there will be no change in the monthly medical tax credit for medical scheme contributions. This means that for the taxpayer and the first dependent on your medical aid, you will still be entitled to a medical aid credit of 310 Rand, and then for each additional dependent, they will be entitled to claim relief of 209 Rand. Let's look at employee travel. When you use the deemed cost table, when you issue travel allowances to your employees, you will notice that the vehicle cost ceiling remains at 595,000 Rand. Where you reimburse your employees for business travel, the rate per kilometre also has been maintained at 3 Rand 61 per kilometre. SARS has, however, updated their standard logbook, which you will find online. They have also vacillated in previous years whether it's a requirement to keep private and business kilometres. For the current tax years, they have noted that there is no need to keep private kilometres in your logbook. In addition, SARS has announced that they are willing to accept electronic logbooks from employees. If we look at your retirement fund or lump sum withdrawal rates, you will notice that those tax tables once again have remained exactly the same. This poses the question for a lot of employees that 500,000 a few years ago was worth a lot more than it is today. So it is a concern that SARS has not considered this in the budget over the past couple of years. Now I'm going to turn your attention to subsistence allowances in South Africa. If you provide a subsistence allowance for meals and incidentals to your employees, you will notice that the rate has changed from 416 Rand in the last tax year to 435 Rand in the current tax year. In addition, if you just pay for incidental costs, the rate has changed from 128 Rand to 134 Rand in the current tax year. However, you will notice that SARS has put an extreme amount of effort into the foreign subsistence allowance tables. They've actually made some drastic reductions in amounts offered in subsistence allowances. And if you look at Egypt, they've even changed the currency that will be used from Egyptian pounds to US dollars. So as a payroll professional, I urge you, if you send your employees away for business outside of South Africa, to please look at those rates to ensure that you give the correct advice with minimal tax repercussions. If we look at the guide for employers for the 2020 tax year, I would like to turn your attention to the accommodation abatement amount. This is where you use a formula to determine the fringe benefit of the accommodation. You will notice that the abatement amount has been changed from 78,150 in the 2019 tax year to 79,000 in the 2020 tax year. Now let's look at how employees are impacted via inflation, which as a payroll professional you should be aware of. There's been a lot of talk around bracket creep. So what exactly is bracket creep? Bracket creep occurs when employees receive, for example, an annual inflationary pay increase which causes their income to fall in the next tax bracket. In prior years, the inflationary adjustments made to tax brackets would have ensured that the person would stay in the exact same tax bracket. The result in the new tax year is that even though their purchasing power remains relatively fixed, SARS sees them as earning more and taxes them accordingly. However, only those few who are pushed into the new bracket will pay more tax, and not as much as you think, because we work on a progressive tax system in South Africa. So I've done a practical example on how individuals may be impacted. If we look at someone who's earning 500,000, in the last tax year, they would have net 386,193 Rand. If we use the new tax tables and the new rebates, that exact same person would have cleared 386,346 Rand. If as an organization you would like to give that individual a 6% increase to counteract the effects of inflation on their net salary, therefore, the net salary should be 409,364 Rand. But the reality is, because of the tax tables not being changed, you would have to factor that into account into your computations. So the net effect would be, ultimately, you would have to offer this employee 7.19% increase to ensure his net pay is adjusted with that inflation amount. Now let's talk about the big elephant in the room, outbound expatriates. This is a very hot topic, and as payroll professionals, if you have expatriates in your organization, this is absolutely critical that you're aware of what is going to happen to your outbound expatriates. Currently, if you're a resident in South Africa, you're taxed on your worldwide income. However, there is some tax relief which is offered via Section 10102 in the Income Tax Act. This section says that if individuals earn money for services rendered abroad, they will be able to be exempt from South African tax if they meet certain criteria. The criteria are as follows. They have to be out of the country for a period exceeding 183 days in a 12-month period, and 60 of those days need to be consecutive in that 12-month period. From the 1st of March 2020, if a South African resident works in a foreign country for more than 183 days in a 12-month period, foreign employment income earned is exempt from tax only on the first R1,000,000, which is subject to the same two conditions that I mentioned before. So the individual would still need to be out of the country for more than 183 days in a 12-month period, and 60 of those days need to be consecutive. What are some of the other important changes that a payroll professional should know about? The one is employment tax incentives. The wage regulating measures in employment tax incentives will be revised in line with the recently promulgated National Minimum Wage Act. In 2018, government extended the employment tax incentive by 10 years. In addition, the eligible income bands will be adjusted upwards to partially cater for inflation. From the 1st of March 2019, employers will be able to claim the maximum value of R1,000 per month for employees earning up to 4,500 monthly, up from 4,000 previously. The incentive value will taper to zero at the maximum monthly income of 6,500. The employment tax incentive, which benefits young workers, once again, has been extended to February 2029. The first court case around this has come into effect on the 13th of December 2018, so it is absolutely critical that you keep accurate records around employment tax incentives. It appears definitely that SARS has an audit focus, but it is worth your while to claim these incentives if you are entitled to do so. Another big change is around bargaining council contributions. In 2017, changes were made in the tax legislation to grant tax relief to non-compliant bargaining councils. However, moving forward, bargaining councils are expected to be fully tax compliant and will not be afforded any relief. Based on public consultations held with bargaining councils and the Department of Labour to discuss the way forward regarding the correct tax treatment of funds managed by bargaining councils, the following changes have been proposed. The employer is required to withhold pay-as-you-earn from employer contributions to the funds administered by the bargaining councils in respect of employees who are members of those bargaining councils. Employee contributions directly to the fund administered by the bargaining councils will not be subject to pay-as-you-earn withholding, as such contributions can only be made from after-tax income. Bargaining councils that did not get an official confirmation of income tax exemption from SARS should pay income tax in respect of amounts received or accrued to them. How would you value the fringe benefit appertaining to your bargaining council contributions? The value of the taxable fringe benefit will be the value of the amount contributed or paid by the employer for the benefit of an employee to the bargaining council. Where the bulk contribution is made by the employer and the employer is unable to determine the value of a taxable benefit per employee, the taxable value per employee shall be the total contributions divided by the number of employees. Please note that this excludes contributions made by an employer to a pension or provident fund on behalf of the employee. Employees' direct contribution to the bargaining council will not be subject to pay-as-you-earn. Let's talk a little bit around compliance, which is absolutely critical that you are fully compliant being a payroll professional. SARS made reference that they have improved their tax administration and transparency. SARS has confirmed that there were problems with their tax administration. As highlighted in the findings of the SARS Commission, it partly explains the poor revenue collection performance. Improving collection hinges on restoring the efficiency of SARS. In the short term, such improvements may be more effective in raising revenue than further substantial tax increases. SARS also made reference in ensuring transparency in their tax administration. To raise the revenue needed to fund its social and economic policy commitments, South Africa requires its tax administration to be efficient, effective, and impartial. Reports by the SARS Commission highlight maladministration and abuse of tender procedures that occurred at the entity between 2014 and 2017. The Commission's main finding is that these failings stem from massive failure of governance and integrity after the appointment of the entity's previous commissioner in 2014. Let's talk about increased international compliance. It has emerged internationally that offshore structures and arrangements are being designed in an attempt to circumvent financial account reporting under the OECD's Common Reporting Standard. The standard is used for the exchange of information between countries. It is proposed that the OECD's model mandatory disclosure rules be implemented in South Africa to identify and counter such structures and arrangements, and that similar penalties to those currently in force for non-compliance with the reportable arrangement legislation be imposed for non-compliance with the rules. To explain this more clearly, as payroll professionals, what you should be aware of is that SARS now has access to all bank accounts around the world. SARS has a big drive to ensure absolute compliance for all taxpayers in South Africa. I have performed multiple pay-as-you-earn reviews for organizations, and I've also assisted on some SARS audits. So as a payroll professional, you need to understand what is SARS's new pay-as-you-earn approach should you ever be impacted with a payroll audit. Firstly, SARS likes to review what exactly is inside your payroll. They will also perform an audit of items being paid outside of your payroll. They use that famous SARS questionnaire to determine the amounts that impact the payroll, which are being processed via finance, for example. But what SARS is now doing is they reconcile the amount disclosed on financial statements with your pay-as-you-earn disclosures. The difference between these two amounts, if it cannot be supported and substantiated by the payroll professionals, the finance director, and the relevant departments, SARS will now levy an appropriate percentage of tax on that amount, and that will then become due and payable by the organization, with potential penalties and interest. So what are the lessons for payroll professionals? It's almost like your first big fight that you would have with your spouse. It's not if, but when you cause a car accident. Reward and payroll professionals must be acutely aware of not being caught out on the wrong side of the law. Tax penalties is one thing, but tax fraud means jail. What are some of the main exposures that we have found when we've performed payroll reviews and audits for organizations? There seems to still be an area of concern when it comes to company cars. Please note that if these company cars are provided to employees under an operating lease, you're not allowed to use the 3.25 or 3.5%, but you actually have to use the actual cost plus fuel as the fringe benefit to the employee. So organizations and payroll professionals should do some planning around this. In addition, what we have noted with organizations is that fringe benefits on retirement funds remain an issue, and employers consistently get it wrong. It is also imperative as payroll professionals that you ensure all items outside the payroll are correctly disclosed, because SARS will audit these items. You also should be very careful of any salary sacrifice schemes which are sold. You must adhere to case law principles, which is never a deduction, and always you must change the employment conditions for the employee. Your child bursary schemes and tax-free meals should be applied, but in a limited way. What are some of the pay-as-you-earn opportunities that are still available to organizations? Your inbound expatriates have different rules, and you can optimize this in a legal way. And the second one is that you should offer increased employee benefit flexibility to your lower level of employees, and especially when giving choices around employee benefits. Where organizations have given zero increases or increases below inflation, all you are left with is better structuring within your remuneration structure. The last item I'd like to touch on are some critical guides as payroll professionals you should really rely on and lean on to make yourself more efficient in your payroll systems and from a tax perspective. The first one I'd like to mention is the Guide to Employment Tax Incentive, which was updated on the 4th of June 2018. The next one is the Guide on the Calculation of Lump Sum Benefits, which is updated on the 16th of October 2018. The third item is the Guide on the Taxation of Foreign Workers in South Africa if you have expats on your payroll. The other item I'd like you to turn your attention to is the Guide on Determination of Your Medical Aid Credits, which was updated on the 23rd of March 2018. And the last one is the Taxation in South Africa, which has recently been updated on the 23rd of January 2019. Those are my key highlights that I'd like all payroll professionals to be aware of to ensure that you are robust and that you are fully compliant in every aspect. SARS has not made budget for quite a few years now, so compliance is absolutely critical going forward. Thank you, and I hope to see you again.